Thank you. I'm Alan Barton from the College of Business and Economics here. My question really follows on from the question that Peter Drysdale asked a little while ago, and it really concerns the control over the supply of credit to borrowers. Now, in earlier times, before globalisation of international markets and so on, the Reserve Bank effectively controlled the supply of money in Australia through the special reserve deposits requirements and a few other things. And now we don't have these requirements from the Reserve Bank of Australia. And also then, the Reserve Bank used to specify for households minimum deposit requirements of 10, 20, 30%, which they would change according to the state of the economic cycle. Now, we don't have those types of controls now. They were very simple and effective in those days throughout the 50s and 60s and early 70s. And the other problem, so there is a question as to whether, and maybe Dr. Grenfell could comment on this, whether the Reserve Bank would like to be given control over stipulation of minimum deposits for household spending, and that would help control the household spending boom.
These are big topics, thanks, but big topics. I won't be able to do justice to them, but I think if you go back to the moment when we moved away from those controls, the reason why we moved away from those controls is that the financial sector had become more complex. It didn't just consist of the banks. So to the extent that you put any of these kind of controls on the banks, you took away the level playing field between the banks and the non-banks. The one instrument that could keep a level playing field across the whole financial sector was the price, the interest rate. If you could influence that, then you could influence intermediation across the whole of the financial sector. When interest rates went up, even the non-banks, the demand for loans at the non-banks would be constrained by the downward sloping demand curve for loans. So in a sense, that those possibilities have gone. What could be put in their place would be prudential instruments, capital, liquidity, loan to valuation ratios, but always the problem of putting a heavy regulatory burden on some groups is that other groups will come along, as the shadow banking sector did, and take over the intermediation role, and they will escape from the net. So unless you can find a way of throwing the net wider and wider when that happens, I don't think there's any easy way of doing this.
And just a small postscript on the complex derivatives and financial instruments. Yes, transparency is the answer, including trading on open markets, so you can see the real value.
I'm sure, Ross, when I read your book, it'll be an economic orgy of insight and wonder. But my question is, when it comes to the academic minds that you've had access to, when we talk about the business cycle, were you able to unnut anything whether institutions or central banks actually create this business cycle, and whether the global central banks should have stepped in, say, in 2005 before the mess unfolded or the tragedy awoke?
Well, we can say now, yes, that the problem is identifying while the boom's still running. And here, Schiller's work at Yale University, which we cite, is challenging. His work on behavioural economics, which talks about human beings wired from our origins on the steppes of Africa to run with the mob when someone runs, having seen a lion. There's strong survival value in that, and we seem to still do it.
Tim Colbatch from The Age. Can I just make two quick points on behalf of the pessimists in response to David, and ask two quick questions. The quick points are first that the bottom line of growth, after all, is GDP per capita, not GDP. And if your graph showed GDP per capita, Australia would not be at the end, because one of the determining things about Australia's exceptionalism is that we've had population growth that has been conservatively estimated at 2.1%. over the year to March and is probably running perhaps more like 2.5%. And that has driven a massive amount of the growth in demand that we've seen in the last year. And secondly, your point on the current account deficit, it's true that in the recent years it's funded mineral boom, but if you take the period to 2003-4, and I think you go back to your graphs and look at what was happening to consumption, that was basically funding a housing price boom. We were borrowing overseas to inflate the value of our houses, and we were very much part of that. And now the question is, why did we break from it? And there was that very sharp point in your graph on house prices where we break away, that boom turns down. And I would have thought, so I'd be very interested to hear Steve and David on this, because I would have thought that what busted that was the Reserve Bank leaning against the wind in late 2003 with those two increases in interest rates at a time of low inflation, which had no purpose other, surely, than to tackle asset prices. So we've already proved it can be done. It was done here. I'd like your comments on that. And secondly, on the question of the macroprudential regulators, I guess is a bit technical, but Steve, I'm just wondering how, if we had macroprudential instruments, who would be the right body to apply them?
Thank you. David,
Just a couple of things. I certainly agree that GDP per capita is the right measure. I would be perfectly happy to do those charts in GDP per capita. It's just a lot harder to do them in GDP per capita than GDP. And it's certainly true that obviously if Australia's population has grown by, as you say, something of the order of 2% or more, then GDP per capita growth has been slightly negative over the last year, no question. And so it's true that rather than being on the far right of that chart, we would come in one or two places. Agree with all of that. Now, I'm not going to argue about what turned the asset price boom, or the house price boom around in 2003. I think trying to identify the proximate causes of those things is always very tricky because house prices get out of line, and then there's a kind of confluence of events, and they adjust. The point I would make, it may be that monetary policy tightening around that time, a couple of small interest rate rises were relevant. That may be true. I would have to go back and look carefully at that situation. But certainly we experienced a very substantial rise in house prices, which largely ran its course, at least until up to 2003. And the point I was simply making was that it was very fortuitous that ran out of steam in 2003, and had it run out of steam in late 2008, we might have been it might have been significantly more serious. There was another point, but I've forgotten it, so I'll leave it there.
Actually, I think I might be able to clarify the hosing down of the house prices. There were two interest rate increases in May 2002. Then there was a pause for about 15 months until November 2003. In the meantime, the housing boom had stopped, and I think Ian MacFarlane would say that it was jawboning more than the interest rate increases. Did you want to comment? I've just done some writing on it.
I'm sure we'd like to take credit for it, but I think the difference is, even if whether it did or didn't do the job, there was a different setting in Australia compared with the US. So relatively speaking, I think Australia showed that you can have better monetary policy, and the jawboning certainly got the real estate agents going. I can remember that well. On the question of who should actually do it, I think there ought to be such a close working relationship between the central bank and the prudential supervisor that it shouldn't matter. You could actually, if you believed that all of your macro talent was in the central bank, I don't see anything wrong with having the central bank tell the prudential authority that it would like the capital ratios raised during the cycle. And I think that's the direction we're heading. counter-cyclical, pulling against the cycle capital ratios. I might say, incidentally, Spain has that in place already, and it wasn't enough to stop things in Spain. So it seems to me you have to do a whole lot of things, but you could actually put in place some that were perfectly automatic. One idea is when people are looking at the value of collateral, you make people average it over the last 5 years or 10 years, so that the boom is, you take out the pro-cyclical piece of collateral, which means that you can get bigger loans as the boom goes on. There's a whole lot of things in place at the moment which make prudential supervision pro-cyclical. You could take those out, and I don't think it matters who does it.
My question is, what averted the Great Crash turning into the Second Great Depression? Did policy play a role in this?
I don't think you can look at the severity of the collapse in that 9-month period, basically from September until June, without drawing the conclusion that the huge fiscal and monetary expansion in many countries was the decisive factor in stopping things keeping on going.
I'm Diana Howlett, a retired geographer. I want to raise a question about another elephant, and that's the elephant in the room. Professor Garnaut's last big project was on climate change, and we're on the brink of the G20, but none of our speakers, except Professor Hill at the very end, made even passing reference to anything to do with climate change. Now, you're talking about the growth of India and China leading to a quadrupolar world. What's that growth going to mean for the global climate, for food security, the impact on Australia? We talk about Australia being more prosperous as these countries buy more of our mineral wealth, but there are other aspects to it, so I'd appreciate some comment on that point. Thank you.
There's a section in the chapter about the aftermath about climate change, drawing a parallel between climate change and financial regulation. And the big question is whether what needs to be done in the national interest and the international interest can be done, or whether the dominance of vested interests in the policy-making process will crowd out the national interest. And we explicitly draw the parallel between financial sector regulation and climate change. And for what are the implications of the continued strong growth in the big developing countries, well, we make the point in that small section of the book, that it happens that these are all economies whose business as usual patterns of growth are highly emissions intensive, and if the mainstream science is broadly correct, business as usual, continued growth as can be expected in the big Asian developing countries would have catastrophic consequences on global climate, and it is not sustainable. Global growth is not sustainable without breaking the link between greenhouse gas emissions and economic growth. The good news is that amongst the countries of the world that are taking this issue most seriously and actually doing something about it, China is right out in front. Some calculations that my colleagues from the review and here at ANU, from the Climate Change Review and here at ANU, Stephen Howes and Frank Giotto have done, suggest that the departure from business as usual of changes being introduced in Chinese policy may amount to about things that you can already see, not things that they've guaranteed internationally, but policy changes that they're bringing in could reduce their emissions by 2020 by about 37% of business as usual emissions. Well, that just dominates anything else that anyone else in the world is doing on mitigation.
Terry Larkin from the Harvard Club. I wanted to ask Ross a question. I haven't had the a pleasure of reading your book yet, but I wanted to ask whether the reserve currency status of the US dollar has any impact or does have impact on your diagnosis of the emergence of the problem, whether it leads to a more relaxed attitude in the United States to economic policy management. And equally, if there is to be a quadrupolar sharing of power in the future, will one see an emerging reserve currency status from those other countries, India, China, Japan, and more so from the EU?
We do discuss the status of the US dollar as the international reserve currency, but more in a forward-looking way, saying, or we note that doubts are being raised about that by the possibility of weakness in the US dollar, and therefore its unsuitability as a store of value looking forward. The big surplus countries of the world are having questions about that. We point out that there's unlikely to be, through an international agreement, the development of a synthetic alternative international reserve currency. There's talk of that from time to time, and the Chinese Premier Wen Jiabao briefly raised that in international discussion and then stopped talking about it. But there may be a de facto movement towards a multi-currency world just through the prudence of the surplus countries leading to a diversification of assets. If that goes very far or very fast, that will increase the costs of US foreign borrowing, and it will add to the many good reasons that the United States will have for rebalancing economic growth towards less dependence on foreign capital. It's very important, if that is going to happen, that it be incorporated into US policy making and done deliberately, because, as we point out in the book, the decommissioning of an international reserve currency can be a painful and damaging process if it happens accidentally over a long period of time, as the decommissioning of the pound sterling as an international currency did between 1920 and 1970.
My name's Greg Carman. I escaped from this institution in 1983 and I've been in private business largely ever since, both here and overseas. I'm interested in sort of the general optimism that seems to be around the place that the crisis is over and that it's all blue sky and sunshine from here on. I'm particularly interested in a couple of elements of that: the view that the household bubble is over, or rather the housing bubble. I think, for example, when I came back into Australia in 2000, coming into Brisbane, coming down the gateway, you could see house and land packages for just under $100,000. Today, those same properties sell for over $300,000. Here in Canberra, last week, a property was advertised for $280,000. Buyers swamped on it, bid it up to $430,000 very quickly. It's a two-bedroom shack. It'll fall over if you breathe on it. It's in the outer suburbs. People are paying for a block of land, obviously on a bulldozer basis, $430,000. Again, you go back to the year 2000 in Canberra and you could buy a block of land for under $50,000. The other thing I'd look at, and again I think this is another of the elephants in the room, apart from climate change, and that's something that Professor Garnaut has touched on. And it's the other shoe that's yet to drop, in my view, and that's over-the-counter derivatives, and particularly credit default swaps. Now, I know there's no market for this. I know estimates are wild guesstimates at best, but the wild guesstimate about credit default swaps is that we have, in the world at the moment, a total value 10 times the value of the total debt of the corporate sector. How is this even possible, let alone sustainable? And I wonder if the panel could tell me on what basis we have any grounds for optimism that the crisis is over.
Did you want to start off? And perhaps David?
Well, the collapse of economic activity has stabilised, so that's the sense in which the economic crisis is over. On housing, I don't think you can be sure that the risk has disappeared from the Australian housing market. And on the risks in derivatives, as you note, there's been a big pulling back from fancy financial instruments since the crash, but without new approaches to regulation, they will all come back, and if you keep on doing what you were doing before and expect a different result, then you're not being very wise.
Any other comments on that? Well, I think at that point we might bring this discussion to a close. I think you'll agree it's been a tremendous discussion, the ANU at its best. I'm sure that this is one of the things the founders of the ANU had in mind when it conceived the idea of establishing a national university in Canberra, that the best minds of the ANU come together to discuss publicly an issue of a great moment, an important policy issue, and to invite the public to attend and to participate in the discussion.